Warren Buffett calls this the best book on investing ever written. He read it at 19 years old. He still says its opening pages have made a bigger difference to his financial life than anything else he has ever read. Yet most people who buy The Intelligent Investor never finish it. Why? Because Benjamin Graham buried the gold under 600 dense, unglamorous pages about interest coverage ratios and bond ratings. Buffett never asked you to read all of it. He said only 2 chapters actually matter, chapters 8 and 20. Everything Warren Buffett has ever taught you about money traces back to those 2 chapters, written by his teacher in 1949. Here are the 5 ideas hidden inside them that quietly built the greatest fortune in investing history. 5 lessons, 5 simple pictures. Master these and you'll think about the stock market more clearly than 90% of professional investors ever will. Let's start with the strangest character in the entire book, a man who isn't even real. Imagine you own a small piece of a business with a partner named Mr. Market. Every single day, without fail, Mr. Market knocks on your door. Some days he's euphoric. He offers to buy your share for far more than it's worth. Other days, he's depressed. He begs you to sell for pennies on the dollar. Here's the twist. Mr. Market doesn't care if you ignore him. He'll be back tomorrow with a brand new mood and a brand new price. Benjamin Graham invented this character to describe the stock market itself. Price moves every day. The business behind it barely changes at all. Most investors treat Mr. Market as an oracle. If he's excited, they get excited too. Graham says that's backwards. Mr. Market exists to serve you, not to instruct you. His job is to occasionally offer you a wonderful price, either to buy from him when he's fearful or sell to him when he's greedy. The moment you start taking his mood swings personally, you've lost the plot. You are not required to trade with him every day. You're allowed to simply say, "Not today," and wait for an offer that actually makes sense. That patience alone beats most professional fund managers. But knowing Mr. Market is moody isn't enough. You also need a rule for when his price is actually safe to accept. Here's Graham's single most important idea, the one Buffett says the other 599 pages exist just to support. Margin of safety. Picture a bridge. Engineers don't build a bridge rated for exactly the heaviest truck that will ever cross it. They rate it for 30 tons when they only expect 10 because trucks get overloaded, materials weaken, and estimates are wrong. Investing works the same way. Never buy a stock at a price that only works out if everything goes right. Buy it at a price so low that even if you're wrong about the future, you're unlikely to lose much money. This is the difference between speculation and investing. A speculator buys because a price is going up and hopes it keeps going. An investor buys because a price is already cheap relative to what the business is actually worth. The direction of tomorrow's headlines becomes irrelevant. Margin of safety doesn't guarantee you'll be right. It guarantees that when you're wrong, which happens to everyone eventually, the damage stays small enough to recover from. Eilstrom venrel spesser inverekression. I may have given what he in word. When your audience averages ever eventualence, the damage stays small enough to recover from. Warren Buffett has repeated this same idea for 70 years, in different words, in every letter he's ever written to shareholders. Only one problem remains. How do you know your own limits well enough to actually follow this rule under pressure? Graham splits every investor on earth into 2 honest types, and he insists you pick one before you start. The defensive investor wants a good, safe return with minimal time and stress. A simple portfolio of large, stable companies and bonds, reviewed once or twice a year. The enterprising investor is willing to put in real hours, researching individual businesses, reading annual reports, hunting for mispriced stocks. Both approaches work. What doesn't work is pretending to be the second type while putting in the effort of the first, checking your phone for stock tips but never doing the actual analysis. Most investment disasters, Graham argues, don't come from picking the wrong stocks. They come from picking the wrong identity, a busy doctor or a tired parent convincing themselves they're a full-time stock analyst on nights and weekends. If you don't have the time, temperament, or interest to do enterprising-level homework, that's not a character flaw. It's just information. The defensive path, done consistently for 30 years, quietly outperforms most enterprising investors who burn out after 18 months. Know which one you actually are before the market finds out for you. Here's a sentence Warren Buffett has quoted more than almost any other line from this book. Price is what you pay. Value is what you get. They sound similar. They are almost never the same number. A stock's price is whatever the last person happened to trade it for in the last 30 seconds, driven by news, fear, momentum, algorithms. A business's value is the actual cash it will generate for its owners over the rest of its existence. Graham's entire method is built on one habit: estimate value first, using boring numbers like earnings and assets, and only then glance at the price to see if it's a bargain. Do it backwards. Fall in love with a rising price first, then invent reasons the value must justify it. And you've become a speculator wearing an investor's clothes. This single habit, estimate value before checking price, is why Graham's students so rarely get fooled by bubbles. When everyone around them is pricing a company off its story, they're quietly doing arithmetic off its balance sheet. It's unglamorous work. It also means you'll sometimes sit out the most exciting rallies in the market. Graham was completely fine with that trade-off, and so, eventually, was every investor who actually got rich following him. Graham closes the book with a definition of the intelligent investor that has nothing to do with IQ. He says, an intelligent investor is a realist who sells to optimists and buys from pessimists. Not someone who's always bullish, and not someone who's always bearish. Someone who simply asks, at every moment, whether the current mood of the crowd matches the actual facts of the business. When headlines scream that stocks can only go up forever, the realist gets cautious. When headlines scream the world is ending, the realist starts checking prices for bargains. Temperament, not intellect, decides who actually wins at this game long term. Graham put it bluntly. The investor's chief problem, and even his worst enemy, is likely to be himself. You can memorize every formula in this book and still lose money if you can't control your own emotions when the market moves violently. That's why Buffett says you don't need a stratospheric IQ to do this well. You need the temperament to detach your decisions from the crowd's mood. A smart but impatient person will consistently underperform a plain but disciplined one. That's the real, uncomfortable secret hiding inside 600 pages that people assume is about spreadsheets. So, 5 ideas from the most important investing book ever written. 1. Mr. Market is your servant, not your guide. Trade with him on your terms, not his mood. 2. Margin of safety. Buy with enough of a cushion that being wrong doesn't ruin you. 3. Know honestly whether you're a defensive or an enterprising investor, and stop pretending to be the other one. 4. Price is what you pay, value is what you get. Always estimate value first. 5. The intelligent investor is a realist, not an optimist or a pessimist, and his biggest enemy is usually his own temperament. Graham wrote all of this in 1949. Not one word of it has gone out of date. If this made the stock market feel a little less like gambling and a little more like arithmetic, subscribe. Next up, the book that reprogrammed how an entire generation of self-made millionaires actually thinks about money. See you there.